One of the things that has come up a lot recently for me in the cases I have on the insurance side is misrepresentations in the application for insurance. Now, what I mean by that is not necessarily insureds committing fraud when they're applying for their insurance. A lot of times it's just a misunderstanding about what the insured is putting down in their application when they submit it. The problem is sometimes if they put down incorrect information in their application, because what often happens is that after a loss occurs and a claim comes in, the information gets to the underwriter and the underwriter says to the claim rep that this is not the type of thing that we thought we were insuring. For instance, structural changes to a building. We've had a number of these types of claims come in. The insured is making structural changes to the building. Something happens. Often a building collapses. The information gets back to the underwriter, and the underwriter says, well, in the application, the insured told us that he did not intend to make any structural changes to the building. And had we known, we would have issued the policy, or we would have charged more for the policy that we issued. And that's really the key with material misrepresentation in the application and the defense that goes along with that, is that the underwriter would not have entered into that agreement had they known the true facts. The two important points that are relevant here is that it is a misrepresentation. The insured has to give false information or erroneous information to a question that's asked. If he gives no information at all and the question is asked and the underwriter decides to issue the policy, then the question arises, was it really material to the underwriter since the insured provided no information to that question and you decided to issue the policy anyway? In some cases, partial information is given. The insured may give information about one claim but not provide information about the 6 other claims he had. And had the underwriter known that, they wouldn't have issued the policy. Materiality is looked at from the point of view of what they would have done prior to entering into the policy itself. And to prove that, just to get to a jury on that issue, you usually need the underwriter to say that they wouldn't have issued the policy. But to establish that as a matter of law, which is what we often try to do, in many jurisdictions, you need to prove it with additional evidence, such as underwriting guidelines or bulletins from the insurance company that say we would not have insured this type of risk, and provide guidance to the underwriter that these are the types of things we wouldn't have done. So with that type of documentation and the underwriter's statement that these are not the type of things that they would have insured, it's usually enough for a court in many jurisdictions to say as a matter of law, the policy is now void from inception because of this misrepresentation. It is irrelevant whether the insured accidentally gave false information or if it was intentional. Because the key here is whether or not these two parties both understood the contract they were getting into. So regardless of whether the insured fraudulently gave erroneous information or just accidentally gave it, the law in most states is pretty clear on this issue, and it is that you can avoid the policy if you're given materially false information.